Our last chapter, Chapter 14, Retirement and Estate Planning. In a short 2 weeks, we've managed to start with how you get a handle on managing your finances, taxes, credit, purchasing decisions, buying a home and a car, insurance, investing, and we're to the end, planning for your retirement. Here are our learning goals for this chapter. Number 1, analyze your current assets and liabilities for retirement and estimate your retirement living costs. To begin any plan, the first step is where am I now? Number 2, determine your planned retirement income and develop a balanced budget based on your retirement income. Then figure out where you want to be. In this case, what you want to do and enjoy in your retirement. Number 3, analyze the personal and legal aspects of estate planning. Sounds a bit fancy for many, estate planning, but it just means working out who you want to get what when you're gone. And number 4, distinguish among various types of wills and trusts. Wills and trusts form the basis of putting your wishes into writing, so they'll be followed when you're gone. So let's get started. When figuring out what you'll need in retirement, some myths need to be debunked. Quote, you'll have plenty of time to save for retirement. False. Start as early as possible to get the benefit of compounding. Saving a little bit will help. You won't necessarily spend less in retirement. You probably won't spend as much on dress clothes, commuting, or lunches, but you will spend more on leisure activities, health care, possibly travel. Retirement may well last over 15 years. We're living a lot longer now. You cannot depend on Social Security and your pension to cover everything. Medicare and your employer's health insurance will not cover everything. The bottom line, you need to start planning on how you are going to supply for your needs in retirement. Key tips. Start saving now. The earlier you start, the more you gain from the effects of interest on interest, time value of money. Use automatic payroll deductions or transfers on a regular basis. Be realistic about your returns. Right now, they're pitifully low. They may get better, they may not. Don't bet on it. If you change jobs, don't cash out your retirement plan. Either keep it as it is or roll it to a new one. Don't touch your savings unless you absolutely have to. This defeats the whole point of compounding. Here's a clear example of why starting early pays off. If you start at age 25, investing $127 a month for 40 years at 11%, I wish we could get that, at age 65, you'll have $1,092,000, a nice retirement fund. If you don't start saving until age 50, to reach the same $1 million goal, you'd need to invest $22.44 per month, over 17 times as much. Starting early, even starting small and not touching the principal, pays off big time. Okay, we've debunked the myths and taken a hard look at the what you have part of planning. Think back to Chapter 2, the net worth statement. That's what you need now. Ideally, you've been looking at yours every year, and it should be increasing. Your home was probably the biggest purchase of your life, and it's probably your biggest asset. If you've built up equity, you can consider a reverse mortgage or sell it, downsize, and invest the difference. You can consider reducing your life insurance coverage as you get close to retirement. Your children are grown and hopefully out on their own, so not as much coverage is needed. Some, but not as much as with a growing family. The general investment rule is the percentage of your portfolio you should have in equities is 100, or some use 110 minus your age. The point is, as you get closer to retirement, your portfolio cannot afford to take a hit, not enough time to recover. So you should shift from riskier equities to more stable investments like bonds. Additionally, you're less interested in growth, more interested in income. Expenses may not go down so much in retirement as they'll change. Some will go down. 401k contributions, work and clothing expenses, and federal taxes. But some may go up. Next slide. Both health and life insurance costs may increase. Medical expenses definitely increase with age. You may spend more on leisure activities as you now have more time to enjoy them. You may want to increase contributions to charity and gifts to your children. And don't forget, inflation will increase the amount needed to cover your expenses, while your income may be more fixed. After figuring out what you're going to need in retirement, we have to figure out where it's going to come from. Major sources for most people: employer pension plans, Social Security or a comparable public plan, personal retirement plans, and annuities. Note that those last two are up to you. Most employers, certainly all large ones, offer some type of pension plan, which is usually at least partially funded by the employer. Frequently, you choose your contribution and it's matched in part by your employer. Both contributions are not taxed until they're withdrawn. The details of employer pension plans differ greatly, but whatever your employer offers, you should take part to the maximum level allowed. A defined contribution plan is one where your employer contributes a certain amount annually. These could be in the form of a percentage of earnings set aside each year and possibly matched by your employer. Or it could be a stock bonus plan where the plan uses your contributions to buy stock in the company. This is risky, as it may focus too much of your portfolio on the company you work for. Enron should be a lesson to us all. Enron employees lost an enormous amount in their pension plans as it was invested in Enron stock. Profit-sharing plans just mean the amount contributed by your employer depends on the profits of the company. 401k plans have become the most popular pension plan vehicle. A 401k is a salary reduction plan in that the employer makes non-taxable contributions to the plan. Your contributions are tax-deferred, meaning you'll be taxed when you take the money out at retirement, at which time your tax rate will presumably be lower. 401ks typically have a vesting period, frequently 5 years, after which the funds are yours even if you leave the company. Quite often, 401ks offer employees the option to choose from a variety of mutual funds in which to invest their funds. Fidelity is a major player in this arena, offering a variety of funds with different investment goals and focuses and allowing switching between funds with no penalty. Remember Chapter 13 in the family of funds. Defined benefit plans are almost a thing of the past, and the name describes how the plan works. You are guaranteed a certain retirement payout based on your pre-retirement salary and years of service. Employers make all the investment decisions, but your benefit stays the same regardless of how the portfolio performs. As you can imagine, this focuses an enormous amount of risk on the company. They're on the hook to pay the defined amount, regardless of how well the investments have performed. Portability allows you to change jobs, taking your pension plan with you. In academia, TIAA-CREF is the vehicle for this. Otherwise, you would need to roll any funds into another tax-deferred plan without touching yourself, so the tax-deferred status is maintained. ERISA, the Employee Retirement Income Security Act of 1974, sets minimum standards for pension plans. The federal government insures part of the payments promised in a defined payment plan. The primary public pension plan is Social Security. You pay into it with every paycheck you receive. It is the most widely used source of retirement income as it covers about 97% of U.S. workers. Social Security was never meant to be the sole source of retirement benefits. It was supposed to be part of a retirement plan. You receive a statement from the Social Security Administration each year showing your earnings record and projected benefits at various retirement dates: 62 for early retirement, full retirement age, 66 or 67, or at age 70. You should check this statement to be sure all earnings are reported correctly, as it affects your eventual benefits. Depending on your year of birth, your full retirement age may be 65, 66, 67. It's been gradually increasing to offset longer lives. You can take reduced benefits at age 62, but they remain lower for life. You can also delay benefits until age 70, increasing your benefits for each year you delay. You must earn a certain number of credits to qualify for Social Security, though most who've been working full-time will qualify. And in certain cases, dependents may receive benefits based on their parents. Check the SSA.gov website for more information. There are other federally funded pension plans covering specific groups of employees. Federal Employees Retirement System covers over 2 million full-time civilian employees. These employees are not covered by Social Security. There's a railroad retirement program that can supplement Social Security. The Veterans Administration provides pensions to survivors of those who died while in the service. And many state and local governments also have retirement plans for their employees. IRAs, or individual retirement plans, come in two flavors: regular and Roth. A regular IRA allows a contribution of $5,500 in 2017. If you're over 50, you may contribute up to $6,500 as a catch-up. Contributions may be tax deductible. Interest accumulates tax-free until you begin withdrawal. You may start withdrawing at age 59 and a half, You must begin withdrawing at age 70 and a half. There's a formula that figures how much you must withdraw each year, and these withdrawals are taxable. A Roth IRA is a somewhat different animal. Contributions are not tax deductible. They're made with after-tax dollars. You can continue to contribute after age 70 and a half. The contribution limits are the same as for a regular IRA. Withdrawals are tax-free after 5 years if you're at least 59 and a half, or the funds are being used to make a first-time home purchase. 2 more types of individual retirement accounts. The SEP, or Simplified Employee Pension, is an IRA funded by the employer to which the employee can also contribute. Contributions are tax deductible. These are intended for the self-employed. A spousal IRA is for a non-working spouse if they're filing a joint tax return. The contributions limits are the same as for the regular and Roth IRAs. If you change jobs, you can roll over all or a portion of your IRA to another tax-deferred plan, as long as you do not touch the funds. An education IRA is also called a Coverdell Education Savings Account. It allows a gift of up to $2,000 each year to each child under 18. The gifts are not tax deductible, but the distributions are tax-free as long as funds are used for education purposes. When you retire, you can begin to withdraw funds from your IRA all at once as a lump sum, in installments, or you can elect to have the funds placed in an annuity. Finally, KEO plans are self-employed retirement plans allowing annual tax-deductible but limited contributions. These have historically been quite complicated to administer. Personal plans do have limits. You cannot leave the money in a tax-deferred account indefinitely, except for a Roth IRA. At age 70 and a half, you must begin receiving minimum annual lifetime distributions, whether you need the money or not, even if you're still working full-time. This chart from page 470 in your text recaps the main details of each of the IRA plans we've covered. In general, your focus should be on the first two, a regular or traditional IRA or a Roth IRA. This is the bottom part of Exhibit 14.5 covering rollover and education IRAs. We've looked at annuities when we covered the time value of money. In its most basic form, an annuity is designed to provide regular income for life. Annuities should be used as supplemental retirement income, not primary. Interest accumulates tax-free, but distributions are taxed as ordinary income. An annuity may be structured to begin payments immediately or at some specified future date. Before we move on from planning for retirement, we need to consider, what do you do if your retirement income's not enough? First, be sure you're getting all the payout you have earned and deserved. Make sure your funds are earning the best interest possible. Consider reducing your spending and save more. Go back to work, part-time or full-time. Only dip into your nest egg if absolutely necessary. As I mentioned at the beginning of this chapter, estate planning sounds a bit formal, like a process meant only for the wealthy. It's not. Your estate is just a legal term for everything you own. Estate planning is simply putting together a plan for what happens to your property at your death. In the phases of life, we go from the accumulation phase to the distribution phase. This is the distribution part. Throughout your life, you're working to build up your estate through savings, investments, and insurance. At your death, you want to ensure that the proceeds are distributed exactly as you wish them to be. If married, you need to think about making sure your spouse and any children are provided for. If single, you need to make sure your financial affairs are in order. You don't want to leave a mess for others to clean up. To that end, you need to be sure all important documents are accessible and legal and that your family and attorney either has copies or knows where they are. This slide lists the legal documents in question. Basically, you need to gather all documents pertinent to who you are and what you own in one secure place. Birth, marriage, and divorce documents, legal name changes, military service records, Social Security documents, veterans documents, insurance policies, transfer records for any joint bank accounts, safe deposit box records, automobile registrations, titles to stock and bond certificates, anything related to your home ownership and mortgages. How do you make sure the distribution of your estate is as you want it to be? With a will or with a trust? A will is simply a legal document specifying who gets what. It can be psychologically difficult to face the prospect of writing a will. It's an admission that we won't live forever, but it's very important, especially if you have loved ones depending on you for support. A standard will run $300 to $400, and it's best drawn up by an attorney familiar with the laws in your state of residence. If you die without a will, it's termed intestate, and your state of residence will decide on the distribution of your estate. You do not want your bereaved family to face any difficulties that could have been avoided by ensuring you have a will and that it's legal. The simplest form of a will is called the I love you will. It leaves everything to your spouse and is usually sufficient for small estates. A traditional marriage share will leave a half to your spouse and a half split among your children. The children's portion and the spouse's may be held in trust with the trustee managing the funds and the distribution. An exemption trust will leaves everything to your spouse except for a specified amount, which is placed in a trust to be managed to provide lifetime income. A stated amount will allows you to pass a specified amount to your spouse. Probate is the legal procedure through a court to prove a will is valid or invalid. Probate is best to be avoided if at all possible, because it's a lengthy and expensive process, and we're going to cover some ways to be sure your estate avoids probate. A will can be in three formats. A holographic will is handwritten, dated, and signed by you. Check with your attorney, as these are not legal in all states. Formal will is usually prepared by an attorney and signed in the presence of two witnesses who are not beneficiaries in the will. A statutory will is one on a pre-printed form available from your attorney or from an office supply store. This would include those generated by software packages. Be careful that these do not include provisions that are not in line with your wishes. A will needs an executor. Spouses can be executors for each other's wills, but once one has died, the surviving spouse needs to change their will. An executor basically takes care of legally closing down the deceased estate, inventorying assets, collecting any money and paying off debts owed, filing any final federal and state tax returns, making any investing or divesting decisions, and distributing the estate as specified in the will. If you have minor children, you need to name a guardian in your will and provide funds for the care and management of those. And don't forget your pets. They need a guardian and funds for care as well. Just consider hotel heiress Leona Hemsley left the bulk of her estate, $12 million, to her Maltese, Trouble. A judge later reduced this to $2 million, but the dog definitely was well taken care of, including a Florida mansion and a full-time security guard. Once you have a will, it's not a one-time event. If your circumstances change, your will should change to reflect that. You move to a different state where the laws may be different. You've sold property mentioned in the will or acquired new property that you want to include. You've gotten married, divorced, or remarried. Heirs have been born or died. Adding a codicil to your will just means adding an addendum to include or delete provisions without rewriting the entire will. Do not make handwritten changes on a printed and witnessed will. A will describing the distribution of property is not the only will you need. A living will specifies who's to make health care decisions on your behalf if you're not capable of making them yourself. This is where DNR, do not resuscitate, would be specified. DNR means that you do not want to be kept on artificial life support. A new addition to your set of wills is the social media will. Most of us have a social media presence, perhaps on several websites. A social media will specify how you'd like your profile to be handled. Your social media executor will need a copy of the websites where you have a presence, your usernames and passwords. They will also need a copy of your death certificate to deal legally with each social media venue. A power of attorney gives someone the legal right to act on your behalf if you become unable to do so. A healthcare power of attorney combines the living will and power of attorney into one document. If you go in for a medical procedure, you will likely be asked if you have a living will and possibly asked to provide a copy of it. A letter of last instruction is not legally binding, but is meant to provide your survivors with information, basically your last wishes, your funeral preferences, cremation, songs you want played, specific people you wish to be notified, location of your will, bank account, and other assets, your Social Security number. This is also where you may want to specify certain items to go to specific people. Anne has always admired Aunt Emma's break front, and I want her to have it. Trusts are a bit more involved, and you'll definitely need an attorney to set one up. A trust is basically a legal arrangement in which a trustee holds assets in trust, manages and distributes them to beneficiaries as specified in the trust documents. Trusts do have specific benefits. A trust can reduce estate taxes. You can avoid probate and transfer the assets immediately. It can manage your assets for you. It can provide income for a surviving spouse. It can ensure that your property serves the purpose you intended and provides income as you wished it to. As with wills, there are several varieties of trusts. A revocable trust can be ended or changed during your lifetime, but does not provide a shelter from taxes. An irrevocable trust cannot be changed once implemented, but does avoid probate and can reduce estate taxes. As we get into more and more involved trusts, it will be more and more apparent why you need an attorney to set one of these up correctly. A credit shelter trust has many other names, as you can see on the slide. Basically, it enables the surviving spouse to avoid taxes as long as the estate is under $10.98 million as of 2017. A disclaimer trust is for couples who don't have enough assets to warrant a credit shelter trust, but they might in the future. It allows the surviving spouse to disclaim some assets, placing them in a credit shelter trust at that time, and it does protect wealth from estate taxes. A living trust is one that's only in effect while you're alive. Fundamentally, it's a property management arrangement, but has the advantage of ensuring privacy, avoiding probate, and relieves you of management responsibilities. A testamentary trust is established by your will and provides most of the same advantages as a living trust. This would be an option if your heirs are not experienced in financial matters. There's an old saying, nothing certain but death and taxes. Well, death and taxes go together. Federal estate taxes are levied on the fair market value of property at death. The IRS defines it as a federal tax on your right to transfer property at your death. There is a $5.49 million exemption as of 2017. There's an enormous amount of disagreement over this tax, with pushes to repeal it coming up periodically. Inheritance taxes are levied on property left to a person in a will and paid by the heir. These are state taxes, and they run anywhere from 4 to 10%. Mississippi does not have any type of estate or inheritance tax. Tennessee stopped levying any inheritance tax as of December 31st, 2015. Gift tax are levied by state and local governments on gifts above $14,000 to a single individual in a single year. The tax liability can be reduced by gifting amounts less than $14,000 in repeated years to family members. This will reduce the size of your estate while also avoiding the gift tax. This ends Chapter 14 and our course coverage. I'll go through the chapter summary slides without comment so you'll have them on record. We started figuring out where we are now and what we're going to have as living expenses. Sources of retirement income, general estate planning, types of wills and trusts,